Hello, welcome back to class. And today we'll be discussing on cost classification and cost behavior. Cost classification and cost behavior. In the last module, we talked about the classification of cost very briefly, and now we will kind of elaborate on them. And this module, we will look into the classification by function, by nature, and by behavior. We also look at the variable, fixed, and semi-variable costs. Also, we will look briefly into the cost estimation and cost prediction. And lastly, we will look into cost behavior pattern and analysis. Cost behavior is one of the most practical aspects of cost accounting, and it helps managers to be able to understand how costs respond to changes in business activities. And for example, a question like what happens when production doubles or sales declines? And knowing which cost increase, decrease, or remain constant enables managers to be able to plan effectively, control expenses, and also forecast profitability. So in this module, we will move from the static cost classification into the very dynamic decision-oriented model that links cost pattern to real managerial actions. Let's look at the managerial view as it pertains to cost classification. And the traditional cost classification, which is by element, by function, and behavior, is important, but the managerial aspect goes further. And when we look at this, we talk about the managers need to know which costs are, one, relevant to a decision, two, those that are controllable by department, and three, variable with business entity activities rather. And this deeper classification helps manager to focus on costs that really impact outcome and support strategic choices such as outsourcing, pricing, and expanding production. Looking at the relevant and irrelevant cost, the relevant and the irrelevant cost. For this, we talk about the relevant cost to be the future cost that differs between alternatives, and they directly affect the decision being made, such as variable materials or labor cost when considering whether to make or to buy a product. And looking at the relevant cost, on the other hand, it remains the same regardless of the decision. And this includes sunk cost, which talks about the cost that has already been incurred, or committed cost, which talks about that which cannot be avoided. Example of this is the 5 million naira cost of an old machine is irrelevant when deciding whether to buy a new one. Only future maintenance and efficiency differences matters in this regard. Looking at the differential opportunity and imputed cost, managers often compare alternatives using differential incremental costs. The first differential incremental cost, and this talks about the additional cost of saving from choosing one option over another. And talking about the opportunity cost, it reflects what is sacrificed when a resource is used in one way instead of another. And for example, using a warehouse for storage instead of renting it out. And another is the imputed cost. When we talk about the imputed cost, they are those that are not recorded in books, but helps measure the true value of decisions, such as the notional rent of an owner's building or interest on owner's capital. And this respective ensures decision reflects both accounting and economic reality. This perspective ensures decisions reflect both accounting and economic reality. Looking at the controllable and uncontrollable cost. This talks about managers can only be held responsible for costs they cannot influence. And looking at that, the controllable costs, they are costs like material usage, overtime, or advertising, which can be managed by specific departments. And we have the uncontrollable costs, which are factory rent or depreciation that are often set by higher management or external factors. And recognizing this distinction promotes fair performance evaluation and helps focus attention on areas where managerial actions truly make a difference. Looking at the cost behavior, every cost behavior in a particular way every cost behaves rather in a particular way as business activities changes, and the patterns in such includes the first, the fixed cost, the second is the variable cost, the third is the semi-variable, which cost, which is mixed cost, and we have the step fixed cost. Talking about the fixed cost, they remain constant in total, but decreases per unit as output increases or rises. For variable cost, the variable cost change in total in different or direct proportion to activity level. A change in total in direct proportion to activity level. Looking at talking about the semi-variable or mixed cost, it includes both fixed and variable components. And for the step fixed cost, it remains constant within capacity ranges and then increases in step when capacity expands. Understanding this behavior allows managers to plan production, pricing, and capacity efficiently. And looking at the fixed and variable costs, they are actually the likes of rent, insurance, management salaries, which remain constant within a relevant range, and they can be committed fixed costs or discretionary fixed costs. The committed fixed costs are long-term and unavoidable, and they include lease payments or depreciation, while the discretionary fixed cost is subject to managerial choice, such as advertising or training budget. And for the variable costs, they are raw materials, piece rate labor, packaging, which change directly without output, but per unit cost remain constant. And for these, managers use this understanding for cost volume profit analysis and break-even planning, as we will still look in the coming module. For semi-variable and step fixed costs, they are costs that contains both fixed and variable parts. And for example, these are electricity bills with a flat service fee plus a usage charge, and they increase with activity but not in perfect proportion. For step fixed cost, they stay constant for a given level of capacity and jump when that limit is exceeded, such as hiring an extra supervisor when production doubles. Recognizing this pattern helps in budgeting, forecasting, and capacity planning. We move to the third aspect of the module, the content, which talks about estimating and predicting cost. Managers often need to separate total costs into their fixed and variable costs, and common method used in doing this are the high-low method, the scatter graph method, and the least square regression. For high-low method, it uses the highest and lowest activity points to estimate cost components. And for scatter graph method, plot cost data visually are made to identify pattern and outlines uh, patterns and outliers. And for the least square regression, it uses statistical analysis for the most accurate cost prediction. And once the cost relationship is known, it can be used to forecast future costs at different activity level. What then are the managerial application of cost behavior? Understanding cost behavior has wide managerial application, and the first is about the cost volume profit analysis, which helps in determining the break-even and target profit level. Another is flexible budgeting, and it helps to be able to adjust budget expectations to match actual activity. And the next is the pricing decision. That is, it helps in identifying the minimum price that covers variable cost. Also, performance evaluation, which helps to to focus on controllable costs to judge managers' fairness. And lastly, strategic planning. The cost behavior helps to the managers to be able to it helps the manager to enables what if analysis. The example include automating production or outsourcing work. In conclusion, cost classification and cost behavior are not mere accounting terms. They are the foundation of effective management. By understanding how costs behave and which are relevant or controllable, managers can move from reacting to problems to anticipating them. This knowledge drives better forecasting, smarter budgeting, and more profitable decision. Thanks for listening.